Ladies and gentlemen, good day and welcome to the Q3 FY25 earnings conference call for PDS Ltd. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Diwakar Pingre from EY. Thank you, and over to you, sir.
Thank you, Rio. A warm welcome to all the participants to the PDS Ltd Q3 and 9-month FY25 earnings call. Investor presentation and the financial results are available on the company website and the stock exchanges. Please note that anything said on this call which reflects our outlook for the future or which can be considered a forward-looking statement must be viewed in conjunction with the rest of the company cases. This conference call is being recorded, and the transcript along with audio of the same will be made available on the website of the company as well as exchanges. Please also note that the audio of the conference call is the copyright material of PDS and it cannot be copied, rebroadcasted, or attributed to press or media without specific and written consent of the company. To give a brief business update and take you through the results from the management team, we have Mr. Palak Seth, Executive Vice Chairman, Mr. Sanjay Jain, Group CEO, Mr. Rahul Rajor, Group CFO, and Ms. Reena Joseph, Deputy Group CFO. I will now request Mr. Sanjay Jain to provide you with a brief update of the quarter. Over to you, Sanjay.
Thank you, Diwakar. A very good morning, afternoon, and evening to everyone. Thank you for joining us today. I am pleased to share that PDS has sustained its growth momentum, delivering a 26% year-on-year increase in the revenue for the 9 months period ended December 24 and reaching a revenue of 9,052 crores. This performance underscores our ability to navigate an evolving global landscape and seize the emerging opportunities and reinforce our leadership in the industry. Rahul Ahuja will soon give you a deep dive into the performance, but I would like to take this opportunity to highlight our key themes in line with our overall strategy. In June last year, we had set forth an aspiration of 555, that in 5 years, starting from June last year, we would aspire to do a 5 billion GMV, which would approximately mean a 3.5 billion turnover, and at that level, aim a 5% PAT. So 555 was the ambitious target. We feel positive that we are heading in the right direction. And as a step in that direction, as an interim milestone, we believe we should be touching 333. What this means is that in about 2 years from now, we're already 1 year into our journey when we started with 555. In about 2 years from now, we should have an order book in hand of about $3 billion. And at that level, we should do a turnover of close to $2.2 billion and generate 3% PAT of the company. So this is not an introduction of any new aspiration or anything deviating from 555. This is to ourselves a check that yes, we should be on track on 555. And as an interim milestone, let's aim to get to 333 in about 2 years from now. And this aspiration, this milestone, we believe would be largely a combination of the organic growth. As you know, we've grown this year 26%, and as we are very close to entering the next year, we're also feeling positive about growth next year as well. So carefully, growing on what we have built. But there would be an element of some strategic acquisition opportunities that we shall be very, very carefully pursuing. So combination of these makes us feel confident to cross this interim milestone. To reach this, we are driving deepening of relationship with the existing customers. For example, with our largest customer, Primark, our growth in the 9 months has been 52%. So there has been, a growth double of that of PDS with our single largest customer. And also build the new customers across geographies to capitalize on the growth opportunities. And that's somewhere when we are investing into US, we have witnessed a 70% growth in North America sales. We also want to diversify into high-value categories and enhance service offerings to meet ever-evolving customer demands. And our investments into general merchandise, our investment into home categories have all started firing and giving results. And therefore, that gives us the confidence that this also would be a key building block to our future. While these two are going to be instrumental in driving the top line, we believe what we have built right now, if I take the 9-month sales and if we just extrapolate that, is about 18,000 crore of top line. And at this level, once we have got such a meaningful engagement with our customer, there is a lot of scope to now optimize on the operational efficiency to improve the profitability of the business. And as a result, the fourth lever is the strategic cost initiatives. That's where we have engaged with BCG to drive margin improvements and support the long-term sustainability. So the combination of these two factors should give us top line as well as margin improvement. Before I discuss further on growth, I want to highlight the major cost transformation initiative we have kick-started with BCG. This 10-month engagement focuses on 3 of our key verticals: Poetic Gem, done out of UK, Simple Approach, done out of Hong Kong, and Techno Design, done out of Düsseldorf, Germany. And these 3 are almost about 50 to 55% of total cost base of the company. And here BCG is working on levers such as fabric, trims, materials, employees, sampling, couriering, just a few of these initiatives. And I think through operating efficiencies, synergies, cost optimization, we believe from the scale that we have built up, there is potential to get synergies, on a high side of 3 to 4%, but surely about 1 to 2% savings from this cost base are surely achievable. And the engagement with BCG actually is on a success fee basis. They feel very confident that they should be able to realize it and then only walk away with the fee. On the growth side, as I mentioned, we will continue a journey of deepening relationship with existing customers and also capitalizing on the growth, and wherein I mentioned about 70% growth in North America. And currently we have an order book of about 425 million from North America, so which I believe, should keep looking well. And 425 million on an overall order book basis. While the order book has a growth of 16% overall, but what is important is that in design-led sourcing, which is our main business contributing to more than 87% of revenue, the growth is actually 25%, over the same period last year. So therefore the main business, sticky business, is actually having a healthy 25% order book growth over the same period last year. So 16% is only because the agency business has been off, Ted Baker has shrunk a bit. As part of our growth strategy, we are also pleased to announce our plans to acquire a 55% stake in Knit Gallery India Private Limited, a leading Tirupur-based manufacturer and exporter of apparel specializing in baby wear, children wear, nightwear and innerwear. Knit Gallery operates close to 14 manufacturing units along with warehouses and worker hostels and has a production capacity of 40 million pieces per year, catering to customers in Germany, US and UK. Some of their marquee customers are blue chip names like Ernst & Family, Primark, TJ Maxx. So they have a very healthy mix of customer base. This acquisition is a significant milestone for PDS, reinforcing India's role as a strategic manufacturing and sourcing hub. It strengthens our expertise in apparel manufacturing in the region, aligns with the Make in India initiative, and also in line with the changing geopolitical dynamics, whether it's China plus one or disruption in any other part of the world. We believe a very well diversified manufacturing base and sourcing base should augur very well in terms of our offering to the customer. We will continue to be asset light, so therefore this is one very carefully chosen manufacturing acquisition in India, and we believe we are done with it in terms of acquiring any unit in India. This acquisition involves an equity investment of 41 crores, and there are some confirmatory diligences are underway, and this investment is payable in tranche over 1 year. And as part of this transaction, Knit Gallery's existing business currently happening in a different entity will be transferred to the entity that we are acquiring. and there will be a business consideration of 34 crores payable over 3 years. So we have taken care that the consideration for the share purchase is built over 1 year, so that the earnings are actually spanning and payment is being made along with what we have believed and seen through audit is the earning potential, and the deferred consideration for the business is done over 3 years or so. The combined business generated 288 crore in revenue in FY24 with an EBITDA of 36 crore, and the transaction is expected to close by May 2025. Additionally, PDS is proud to be the fashion partner for BharatTex for the second consecutive year, and in this event, we will be showcasing our key verticals, Poetic Gem, Techno Design, DBS Lifestyle, PDS Venture, and now Knit Gallery as well. And as part of our effort to synergize on the cost area, we are hosting our first ever global suppliers meet. Its first edition is in Delhi on the 18th of February, wherein we are bringing together domestic and international vendors. So far, the vendors have been individually dealing with the verticals. Now we are showcasing that you are actually catering to an enterprise who is generating close to 80,000 crore annual revenue, and therefore showcasing business, showcasing higher opportunity to our vendors, and as a result, deriving on synergy benefits. Looking ahead, the macroeconomic environment presents both opportunities and challenges. So far this year, we have stayed ahead of the initial 10% guidance. Global trade volumes are expected to rise, yet the geographical shifts may redefine some trade partners, but we believe our step in India is in the right direction in terms of showcase as a manufacturing sourcing base. At PDS, we remain focused on agility, resilience, and strategic foresight to adapt any changes. With this, I now hand over the call to our Group CFO for a further deep dive into our financial performance.
Thank you, Sanjay. Good day to everyone. Building on our strong momentum, I am pleased to report that PDS has delivered another quarter of robust growth. For the 9-month period of FY25, we achieved a top-line revenue of 9,052 crores, reflecting a strong 26% year-on-year growth. Our GMV, gross merchandise value, grew by 16% year-on-year in Q3. We reported a profit after tax of 43 crores for Q3 FY25, which is a 66% YOY growth, and 167 crores for the 9-month period ending December 24, reflecting a 22% year-on-year increase. Our normalized PAT, after adjusting for new businesses, stood at 78 crores for Q3 FY25 and 289 crores for the 9-month period, with margins of 2.6 and 3.4% respectively. Analyzing our segmental performance, the sourcing segment expanded by 26% over the 9-month period, contributed by existing business expanding by 21%, and sourcing as a service and the new verticals contributing to the rest. We witnessed a blip of around 40 bits in sourcing gross margins, which were mainly attributable to loss of Ted Baker agency business. Our manufacturing segment achieved a 42% year-over-year growth, generating 532 crores in revenue. The segment reported an EBIT of 5.6% for the 9 months. Acquisition of Knit Gallery will further boost our capabilities in India and enable us to drive best practices and leverage scale. Excluding our new business investments, we clocked a return on capital employed of 25% and net debt to equity of 0.21 and a net debt to EBITDA of 0.82. With this continued momentum, we are en route to our 555 strategy and aspiration, and we shall get to the goal of 333 in another 2 years. We would now open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from Dhwanil Desai from Turtle Capital. Please go ahead.
Hi, good afternoon, everyone, and congratulations for a good set of numbers. So my first question is, the investment in new initiatives. I think the two items that stand out are the US and the brand management side of it. So how should we look at both these items going forward into FY26? And overall investment, I think we were we have alluded that, it will start tapering off from second half and maybe it will go down significantly next year. So are we on course to that? That's my first question.
Yes, we have peaked out on the investment in new verticals in Q2. In Q3, they are about 10% lower as compared to Q2. And so we have peaked out. That was one of your question. And in terms of the outlook for next year, we are looking at investing half of what we have done this year. So they should actually come down to about 50 to 60% of what we have done this year.
Okay. So essentially, so I think probably this year we'll do 130, 140 crore kind of a number. So next year we should look at 70 crore kind of a number. Is that a right number to look at?
Yeah, I think broadly, yes. Yes, please.
Okay. So second question is about this intermediate, target that we have set for ourselves. If I look at net of investment, on 9-month basis, we are already at 3.4% PAT. And we are saying that in 3 years we'll reach at 3% PAT. So, and we are doing a lot of cost management initiatives. And investment side also we are saying that it will taper down. So we're already there in terms of that number broadly, if the investment part is not going to scale up significantly. So not able to understand, whether the operating leverage benefit with scale, why it will not get reflected in that PAT number.
I think your observations are, in place, and we have also said that in about 2 years, which means FY27, you should see us at full year 3% PAT, and right now we are at 2%. If I, currently we at about 1.5. If I just talk about the full year, we should be closer to 2% or so approximately. And then we have to add that 1% extra, post our investment. So nothing to be excluded. So yes, with the initiatives in hand, with the investments peaking out, with the cost initiatives in place, we are confident we will get there. Your observation is in place, but allow me to be a bit conservative, so that we should at least be working towards surpassing this rather than giving a very ambitious number and struggling to meet it. But we believe we are in the striking distance and we are getting there.
Okay, sir. And one last question, I come back in the queue. So, sir, this 3 billion intermediate target, again, I think if I look at the numbers and even if we continue with the current run rate of 3,000 odd crores, probably we will hit the GMV of $2 billion this year. So from 2 to 3, how large the US is going to play a part in that, and where are we in that journey? From going from 400-500 million to $1 billion. What are the key customers where we are seeing traction? Scaling up of the business. If you can give some more color on that, that would be very useful.
I think I will take the initial part of the question, and we also have Mr. Palak Seth, who's dialed in from London. I'll be soon requesting him on the later part of your question. I believe from a 2 to 3, in terms of the extra 1 billion, we believe while North America, would keep adding, you will see the exponential impact of US takes time, so from in the 3rd, 4th, and 5th year, there would be more and more meaningful impact of North America, and that should take up to 5. But for the intermediate aspiration, we believe whatever we have built in terms of our existing design-led sourcing business, the pace at which we are growing in North America, the acquisition of Knit Gallery that we have done, the fact that my GMV of design-led sourcing is 25% up. We believe we are well in shape on the current business we have built to grow at, say, about 15% next year, and therefore be in a comfortable position to get to the 3 billion GMV. The US, as it fires exponentially, is something that will come on top of it. For the next 2 years, we are building in a careful calibration, not building in any kind of exponential expansion from the US business. So that's the math part of it. I'm just requesting Mr. Palak said, as you asked about the customer engagements and which all customers are we engaged with. Palak, I request you to chime in, please.
Hi. Yeah, good morning, good afternoon, everyone. So I think, the fundamental difference between the US and the UK and European businesses, in Europe, UK business starts small. It's engagement at our teams with the buyer and the designer level. And from there, orders are coming and trickling down and takes few years to grow to a sizable number. Whereas the US business takes a longer time to start because it has to be a company-to-company engagement. People below in our team versus a retailer's team cannot get the business started. But once those engagements are finalized between the CEO of a large retailer and PDS at the management level, the business flows very quickly and scales up very quickly. So it will take us 10 years to scale with a European retailer of a similar size and scale. The same scale could be reaching 2 to 3 years with the American retailer because the strategic alignment that PDS is going to have or any supplier is going to have with the American retailer on a company-to-company basis. So US is going through a big transformation. There are I think they're 2 years or 3 years behind Europe in restructuring. So in Europe, we have seen a lot of SG&A cost cutting in the European retailers. They're getting their own overhead down. They're coming to suppliers for services and asking them to take on more of the cost, but also in return guaranteeing large businesses, a large volume to work with the supply base. So in US, that transition is just beginning to happen now. The last 12 months we are seeing. So customers like Kohl's, have gone through a big transformation. Even yesterday, they announced 15 to 20% cost cut at the head office level. Children's Place, another large American retailer, is starting to engage with us. And, Walmart, Target, Fashion Nova, those conversations are quite strategic and moving in the right direction. And the biggest retailer that we have just started conversation is Catalyst Brands, which is a merger of JCPenney along with this brand like Aeropostale, Brooks Brothers, Eddie Bauer, and Forever 21. So I think the good thing is our US investment at the strategic level started almost 18 months ago now. We have made inroads with the senior leadership of all relevant, credit-worthy American retailers as of now. They've started understanding our business model. They started opening our account, and then they're talking about large business volumes. In the next 12, 24 months, we start seeing, hockey stick impact into some of these large accounts as well. Our investment in people, the people we have invested, they have turned out to be good. They've had those relationships, they, with their reputation, their network, along with PDS branding and PDS infrastructure, seems to be working well. And these American retailers are seeing value in what we offer. And I think US could overtake our European business in the next 2 to 3 years if all these accounts that are talking numbers with us starts firing the way they're supposed to. I hope I've answered the question.
Yeah, that's fantastic. And thanks for the detailed explanation. And wish you all the best.
Thank you.
Thank you. Before we take the next question, a reminder to participants that you may press star and 1 to join the question queue. The next question is from Ankit Gupta from Bamboo Capital. Please go ahead.
Thanks for the opportunity and congratulations for a good set of numbers. So my question was on the brand management side, the way, how things have shaped up on the Ted Baker side. How important is this piece of business for us to achieve 3 billion and finally 5 billion GMV that we are targeting over the next 3 and 5 years?
Let me start by taking this.
Yeah, sure.
So I think, one thing we all need to be clear that for PDS, we are a, licensed, the brand owner is a company in the US called ABG, Authentic Brand Group, which is continue to grow, continue to expand. They just acquired Champion. They're talking about taking more brands as well. So PDS is a license of Ted Baker. So we run the global design group servicing all the global franchisees, and then we also run the UK European wholesale business. So some of the negative press we saw around Ted Baker last 12 months was predominantly the retail partners ABG had selected in US and Europe, which financially could not handle the working capital requirements and went out of business. So as a result of that, the Ted Baker stores do not exist. But if anyone wants a Ted Baker brand, they have to come to PDS today for the wholesale. So if you want to buy a Ted Baker earlier, you could go to a shop. But because the shop is not there, e-commerce site is now up and running. But only wholesale channel the brand is available. So as a result of which, PDS business has actually benefited from the demise of the retail shops, which is happening across the board in the whole thing. And, our wholesale business has stabilized and continuing to grow because the product is right. Second, the company we have in UK is called New Lobster, which is basically having Ted Baker as one of the brands. You must have seen the press announcement a few months ago. We signed Draper James, which is Reese Witherspoon's brand as well, to use the same team and infrastructure to add other licenses to distribute in the market. So I think, so Ted Baker, the whole situation restructuring actually benefited PDS because the wholesale business started growing. Any concessions were converted to pre-sold inventory, which also the concession existing in Europe and UK, which we don't want to take any inventory risk. So we told those customers, if you want to buy the Ted Baker product, you have to buy it outright from PDS. We will not give you on a sale or return or consignment basis. So hope that answers your question. And that business will continue to grow and flourish. I think, we are seeing a much larger growth momentum than the overall PDS growth into that New Lobster company because of Ted Baker growth next year, but also some of the other brands we are onboarding, utilizing the same team to design, develop, and market other brands in the same, similar mid-market segment.
Sure. But Saurabh, in our ambition to reach, 5 billion GMV by FY29, how important is this piece of business for us? As in our investor day, we did highlight that, this is expected to become a big,
It's very important. It's very important. Like I said, we are having the industry changing. The New York IP companies between ABG, WSP, Marquee, Blue Star, Iconic, there are 5 big players. They have reached around 50 billion in retail, which has been closed down and become IP. That 50 is going to become 100 billion next 3 to 4 years. As soon as the demise of independent brands happens in the West, I just heard Dockers was on sale, Versace is on sale. So it's unbelievable. The amount of standalone fashion brands cannot survive as individual businesses are all being acquired by New York IP companies. So more that happen, the more these New York IP companies require people to operate those businesses and pay them a royalty. So for PDS, the opportunities are almost unbound. The reason we are a little bit slowed down the signing of new brands is because we are just trying to make sure that the whole Ted Baker model we had acquired because the disruption in retail last 12 months is stabilizing. So we are seeing positive, definitely positive outshoots in our 24, 25, 26 budgets, what the CEO of the company has given us. So once we start seeing, the profitability increasing and emerging to the level we require, we will then, take on some of the other licenses because there's no upfront investment required. It's all variables. You take the brand right, you distribute, you utilize your entire existing resources, to help the sweat your current asset or people, and then offer your customers another brand rather than just one brand as a offering. So, the good thing is, because of the PDS structure, you all saw that acquired a manufacturing unit because that was the required that we should have one manufacturing, right? As a base, like you have in Bangladesh, we have 100 million own manufacturing, we do over 1 billion outsourcing. Similarly, in India, if we have one manufacturing, we can, do additional outsourcing. So in all the 4 segment PDS operates manufacturing, design-led sourcing and service, and brands. There are opportunities emerging, and with the very clear financial KPIs, we're evaluating, what to do, what to restructure, what to invest in, and take the whole thing forward. So all 4 segments are important, right? As long as there's no inventory risk, no credit risk, there's a scalable business within 2 to 3 years, which is profitable. Carefully, we're evaluating and seeing.
Okay. So next year, can we expect some more brand engagements on this segment front, let's say, and not just from the European business, but even on the US side as well?
Yes. As I said, there are a lot of American brands that are being acquired by the New York IP company. They come to PDS to operate. A lot of them keep getting offered to us for India, for Middle East, for, Southeast Asia, so around the world. But we have to be very careful. We're just evaluating the working capital requirements. We're evaluating the overhead structure. We don't want to get into physical shops. We just want to maintain wholesale, maybe some small e-commerce. So the opportunities are, the good thing is there's no other company like PDS in at least Europe and, some of the bigger markets we operate, UK, where there are other operators who can give these New York IP guys the services they require. So they all end up coming to us and almost fighting for attention. Like, can PDS do it, for them? So we have to pick and choose, the right partners and also the right opportunity.
And
next year for PDS about, consolidation, making sure that all the investments we did last 12, 18 months start working. Whatever not work, we start, cutting our costs and making sure that we focus towards the 333 journey and from there towards the 555 journey. So there's no lack of opportunity, which is and there's no competition of other people pitching for those opportunities, right? So if you don't take it, they'll be still available in 6 months' time. That's a good thing. There's no other 5 PDSs, around the world which have been created based on our, platform entrepreneurial structure, which any of these guys can go and pitch towards. So we have that unfair advantage in our industry. Unfortunately, there is no other scale-up platform that is able to work with these, changes and dynamics in the industry to give the services to either the retailers or the brand or the New York IT company, the way the industry is evolved. There's no scale company. The other biggest competitor we have is now 1/3 our size.
Sure. And my second question was on our intermediate target of 333, and if we look at our long-term target of around 555, so there's a huge jump in the PAT margin that we are expecting, as well as the sales in the later half of, let's say, the 4th year and the 5th year, from $3 billion to $5 billion over the next 2 years, like in FY28 and 29, and our PAT margin improving from 3% to 5%. So does it mean that a lot of the investment that we are doing currently and the effort that we are putting up, a large part of that, the fructification of that will come in the 4th and 5th year?
I think first is 333. Sanjay, you want to answer, please? Yeah.
Yeah. So, just to put things in perspective, when we talk about a 3 billion, that should give us, on a 70% conversion ratio, about $2.1 billion of US revenue. And it's approximately, 18,000 crore of revenue. If I just extrapolate the first 9-month performance, we are at 13,000 crore this year. Our GMV overall is up 16%. Our GMV in design-led sourcing business is up 25%. So therefore, company, if it just grows at 15% next year and thereafter, it should clearly enable us surpass the 18,000 crore top line and approximately 3 billion GMV. So it's a realistic number that we believe is achievable in about 2 years from now. And as I mentioned earlier, that we are, taking a North America aspiration ahead. The teams are in place. The business has started clocking in good growth, and one should see the exponential impact of that, in the 4th and 5th year as well. So therefore, what we have set out, as our ambition, I just did the math for the next 2 years. We believe we are getting there. The order book in hand is well in place, and the initiatives on the synergies, cost optimization side also gives us positivity and confidence to touch the 3% PAT.
Sure. Thank you so much, and wish you all the best.
Thank you. The next question is from Srinjana Mittal from Ratnatraya Capital. Please go ahead.
Hi, and thank you for the opportunity. I have 2 questions. So first is if you can give some numbers on the tech baker sales and what is the sourcing as a service portion of the revenue.
Yes, Rahul, you want to add that? Otherwise, I have it handy. So Ted Baker, in the 9 months period ended December, we did about 355 crores of revenue. And in sourcing as a service in the 9 months period, we did approximately 13 million into 87, approximately 113 crores we clocked in. So Ted Baker was flat. If I talk about the same period of 9 months last year, as Mr. Pallet said, explained, while we lost the agency business because of the stores shutting down, but we got our act together on the wholesale business, and the wholesale has got good traction. So our top line is flat in Ted Baker as compared to last year, which I said is approximately 355. And in terms of the sourcing as a service business, there we have actually experienced a healthy growth in terms of over the same period last year. Our growth is about 54% in terms of the top line growth. We were at 13 million last year, and we are this year, and 8.5 million last year. So 50% growth in sourcing as a service business, and Ted Baker flat, the wholesale business overcompensating the decline of the agency business.
Understood. That's very helpful. One more question that I had was, so I was trying to understand the movement in the net debt. So if I just look at last quarter versus this quarter, the net debt has increased by 200 plus 250 odd crores. And if we look at the sales number, the sales is almost similar, right, compared to the last quarter. So that would suggest that we have not made any operating cash. In fact, the operating cash would be on the negative side. So what would be the reason for that? Is it largely working capital? If yes, like which part of the working capital is contributing to this?
So, if you see our balance sheet for December 24 versus December 23, the corresponding period, you're right. We have seen expansion in our balance sheet, particularly around, if I were to talk about core working capital, which is inventory, trade receivables, and our payables, the net increase has been around 338 crores. And if we were to just talk about trade receivables versus trade payables, the increase has been around 230 crores. So we did this to ensure that the growth that we were driving is achieved, and we let our balance sheet expand. However, that said, we have very clearly now identified, from this quarter onwards, how are we going to contract the same. When I say contract the same, reduce our total outstanding debt. For example, in Primark, which is our largest customer, we grew our business over the same period last year by almost 550 crores. Now, in Primark, we went to our bankers and they have increased with effect from 1st of January the factoring that we do from 80% earlier to 90% now. So if the invoice of 100 rupees, they used to give us 80, now they will give us 90. This will lead to a release of about $3.5 million of working capital. We have also introduced vendor supply chain lines in our businesses, two large businesses, particularly Nord Lanka. We have got a $10 million line, which has already started getting utilized, which means, our vendors will get, paid upfront. Obviously, they bear the interest, and this goes off our debt and appears in the account payables. So that will release close to 80 to 90 crores in this quarter, given Nord Lanka is a large business for us. Similarly, for Ted Baker, we have a $10 million line in place for factoring their receivables. Currently, our bankers have approved about 11 customers of Ted Baker, which we expect that in this quarter, about $4 to $5 million of factoring will take place. Already that number is at about $1 million. As we receive and ship more and receive the documents, the banks will, we expect about $4 to $5 million, which is around 35 to 40 crores of factoring upfront, which again releases my working capital. Similarly, to your question, you would see an expansion in our inventory as well. Both our factories in Bangladesh are running a tad over capacity in this quarter, and close to $4.5 to $5 million of goods which were appearing in December balance sheet have already been shipped. So to that extent, my working capital consumption will also come down. I will realize, those inventory getting converted into receivables and actual cash. So if you put all of these together, we expect that in this current quarter, we should reduce or contract our balance sheet close to about 160 to 175 crores and the corresponding impact on working capital as well.
Understood. That's very clear. Thank you so much and all the best.
Thank you. The next question is from Naveen Vijay from NS Capital. Please go ahead.
Good evening, everyone. Congrats on the recent acquisition of Net Gallery. I have a few questions on those. What would be the total consideration? You mentioned equity portion is 41 crores. What would be the net debt that we have to take on our books?
It is 96 crores of debt that we are going to take on a balance sheet, and it is primarily working capital. And one more thing to be seen when we talk about this working capital debt, the profile of the customers is blue chip. I mentioned about Ernst & Family, Primark, TJ Maxx, and these are creditable customers wherein non-recourse factoring is available. So in due course of time, PDS would be bringing in its best practices here. But to answer your question, it is 96 crore and almost 85% of that is working capital.
Got it. Also in the filing, you mentioned part of Net Gallery business will be transferred from existing firm. So what portion would that be? So there is a partnership firm and there is a private limited company. Is all of the partnership firm getting transferred into the private limited firm, and then in the combined entity we are taking 55%? Is my understanding correct?
Yes, you have summarized it well. They have been conducting business across two entities from the partnership firm under the business transfer arrangement. The entire business is moving into the company where we are acquiring 55. There would not be any single rupee business of Net Gallery related to garment that would be done outside the entity where we are getting the economic stake.
Great. Just want to get a feel of the net margin profile of the combined entity, sir. You mentioned EBITDA is 36 crores. Just wanted to see if there is any net operating losses and if we can have any tax advantages out of it on the EV side, on the enterprise value side.
So I think what we have acquired is a profitable company, so there has not been any loss carry forward. But having said that, at present, their net income margin, the PAT margin, are better than that of our own manufacturing business. They are at about EBITDA margin is 13%. For FY24, PAT margin is about 6%. Our own business that we have been running in Bangladesh companies is a 7% EBITDA and 1% PAT. We believe, there is room for adoption of best practices, and the combined turnover of both these companies, Net Gallery and PDS Bangladesh entities, is about 900 crore. So we see that let us adopt a path that form a combined 3% PAT, 7% Net Gallery, 1% PDS. From a 3%, the next intermediate goal is 5%. So, in about 1.5 years from now, we feel very, very positive. We are also getting a senior industry leader, because there is 2 factories in Bangladesh. There is now 1 factory in India. There is 1 factory in Sri Lanka, Nobles, where we have a 26% stake and we have an opportunity to step up to 50. Now, all this put together is approximately a business about 1,200 crore. and a senior person should be able to showcase the manufacturing prowess to the customer. So these are some synergies that we are going to realize in due course of time.
Wonderful, wonderful. That's great to hear. You mentioned 14 factory buildings. What portion of these, how many members are owned and then how many are rented? At least just to get an asset profile of the target entity.
So all of this would be rented, and the rental cost is kind of netted off from the EBITDA, and that's how we arrived at normalized, and that's how the consideration got settled. So all of this is rented premises. In fact, we've been very careful in response to one of the previous questions. I mentioned that almost 80 to 90% of the debt is actually working capital. So therefore, and for that, the inventory receivables all belong to the business.
Excellent. Thank you for your detailed answers on this, sir, and all the best. Thank you.
Thank you.
Thank you. Next question is from Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah, hi Sanjay and Bharat. First thing, we have taken upon ourselves a very elegant business model of simplifying the pain points of our clients, be it manufacturing, be it sourcing, be it design, and now even kind of branding and marketing services. But in the process, our own business model has become somewhat complicated given multiple clients, multiple brands, multiple manufacturing, our own efforts in that direction plus branding. So how far in the journey of simplifying our own business model we have reached while we have sought to simplify the business models of our clients?
Bharat, thank you for your question. This is Sanjay Jain here, and I think we have chosen clearly 4 segments to pursue our growth. The design-led sourcing, the largest piece, then we added sourcing as a service, then brand management and manufacturing. We are into these 4 segments, and for the foreseeable future, we will continue to be in these 4 segments. In fact, the India manufacturing that we have done has been a very carefully curated thought process that we have spelled out even 1 year back as well, that in the retail headquarters of any of our customer, when they look at global sourcing strategy, India is definitely a destination from where they want to increase more sourcing. In fact, a bit of disruption that happened in Bangladesh has further reinforced. While Bangladesh has stabilized, but from a risk management perspective, customers want to diversify and add India as a base as well. So therefore, to demonstrate that PDS very well understands what it takes to manufacture in Bangladesh, I had 2 factories. What it takes to manufacture in Sri Lanka, I had 1 factory. And now, to demonstrate, every country has its own nuance of labor and managing the local nuances. So Tirupur is the base. So therefore, we went ahead and carefully done an acquisition with blue chip customer. And I also mentioned earlier, we're done with it. So I guess we are very well remaining. Ted Baker, we have been very positive. Yes, it went into a bump with the retail stores, but we have quickly, it is power of PDS that through our existing B2B relationship businesses, we could get the wholesale business into Ted Baker and have stabilized it. And as Palak said, many opportunities are knocking my door to pursue in the brand management direction, but we are going slow. We want to make sure that the Ted Baker experiment should be fully successful. We are almost there. And lastly, and very importantly, in fact, in our own investor presentation on slide 20, we have also verbalized our thought process that on a y-axis, we have talked about how we would pursue our growth through, the carefully curated strategy, market services. But very importantly, on the x-axis, for everything in terms of cost synergies, people practices, technology, we have said one PDS. I think I need your attention to appreciate the fact that what we have built is about 13 to 14,000 crore top line company looking very well on track to 18,000 crore. We built that kind of engagement with the customer. We built that kind of relationship with the customer. The time has come also to start synergizing and reap the benefit of that. That's why we have taken up these cost transformation projects. I believe very humbly, we are restricting ourselves to the 4 segments that we have chosen, and we have taken the task now onto ourselves. Yes, meaningful engagement has been done, meaningful size has been built. Let us also synergize and augment our profitability.
Yeah. Mr. Bharat, I just want to add a few points what Mr. Jain said. I think, the reality of the global industry is maybe India is going through a growth phase because of, what's happening in the capital markets. The valuation for retailers is, giving a lot of value to retail businesses. In the West, there's a huge consolidation. If there were 1,000 brands that were operating 15 years ago, today that number is maybe 40 or 50 global retailers who are credit worthy and able to survive. But there are 20,000 suppliers out there who will chase these, 50 retailers for business. So how do you differentiate yourself from just being another supplier, just being another factory in the middle of Asia, or just being another agent, or just being another, design-led company? The way PDS is structured itself, based on the professionalism management, the quality of people we have got, and ability to provide them the services, understanding their pain points, in making us become closer to them. So they are saying, why do we have to deal with 100 other people or 200 other companies? If PDS has got the right caliber of management, right capital structure, right governance standards, right global infrastructure, then, PDS on a transparent basis is willing to work with us, then we do more with PDS. So that unfair advantage we have over those 20,000 SMEs in our industry is what these big 50 retailers will become bigger and bigger because the industry is not shrinking. The industry is not shrinking. The clothing industry globally is still 1 or 2% plus minus every year. India maybe is having 10-15% growth. When the rest 1-2% growth is happening. Then fewer hands. So, everywhere we meaningfully engage, we are able to then get traction and, do the business. So the investment we have done to move from a product company to a services business by offering these 4 services Mr. Jain has mentioned is bringing us closer to our customers and, forecasting the larger opportunities and, the business stickiness. They can't replace us. They can replace a factory. They can replace a manufacturing group, but they cannot replace PDS that easily today from their, network and their service providers. I hope that answers your question, please.
And when we talk about brand clutter, which happened in Europe and America over time, and now it is disintegrating and consolidating. When these brands are acquired by PE firms and they come to us, how exactly we are in a position to help them? I mean, if the PE firms are owning the brands, how do we ensure that these brands actually reach retail stores? Because somebody at their end needs to be helping in the brand nurturing and all that. So how exactly this happens at your end?
So the good thing, many of these PE firms are actually not retail specialist operators. They don't understand sourcing, they don't understand design, they don't understand digital. So they rely on experts in the industry to provide them the services. So as I said, very few companies have a size scale, global reach, global presence, to be able to offer them that service on their doorstep around the world. So they come to us, they lean on our expertise as a group, they lean on the quality of people we have hired in our company to be able to provide them those services. So one, they cannot hire those people. The reason PDS is able to hire the best talent is because we provide equity on the structure we create. So everyone in our industry today, be it a sourcing director or a buying director of a retailer or a manufacturing, person says, we rather join PDS because there's no bureaucracy, no politics, no power center, there's equal option, there's mutual respect, our culture is good. We have this ability to bring people, give them ownership of businesses. So from being employed, they become owners of companies with us. So become that platform. So the PE firms realize they cannot hire the people that PDS can hire because of the way we are structured, our culture and our our incentive structure. Plus also the deep expertise we have where we can share knowledge across 50 other customers we are working. So the PE guy is trying to be more and more closer to us. The amount of engagement we get now is much more, than the retail summit or, global retail, any global retail summit they want PDS to represent and, talk about our business model today.
So essentially, these PE firms consolidate many brands under their house, put some skeletal staff which will help in reaching those brands to the stores, and you do the rest.
Yeah, we do the rest. So a IP company acquires a brand, then they find global partners who run the brand. So typically for UK, Europe business, they come to PDS. They're coming to us increasingly for India opportunities that you want to take in India, the brand you can do as well. And then they go to someone else in the US, someone else in China. So there may be 10 global partners they try to work with for, running the brand and paying them a royalty.
Also on the business model, we have built our business by partnering with many local entrepreneurs in different geographies, in different arenas, be it manufacturing or brands or whatever. The idea being that it keeps organization high on entrepreneurial talent, and the individual entrepreneur solves the issues and problems and brings the value on the table. Now that we are moving towards system level, technology level, sourcing level, consolidation, do you think there is some stress at margin in running more laissez-faire kind of a model that we ran to a little bit more centralized model now we are seeking to run? And whether in the process of centralizing, albeit not everything, but some of the core operations, but still, when we seek to do it across many different partners in different geographies, it has potential to produce its own stress. Do you think this is more a positive energy, or we still are kind of trying to work through the situation?
The good thing is our model is proven. It's been going on for 25 years. It's not that was, came up in the last 1 or 2 years. So it's a proven model. Other good things, global talent in the industry. Every customer of PDS today comes and tells us if an opportunity comes, we would be honored to come join you and set up a business. Right? So they respect these global directors of sourcing or brand or, buying directors. They are our customers today. So they come and say, we want to become part of the group because we've seen our colleagues who have joined you, who have succeeded in the right culture and right incentive framework. So that is a huge positive and respect, the global industry has for PDS today based on the culture and the incentive structure we have created. So that is on one side the positive. The ability to attract the talent, the ability to let the talent get on with the job without bureaucracy, politics, power center. That's the beauty of a model. On the consolidation side, right, what PDS wants to control centrally is risk and cash. Now, they're the two things that are the most important. So we manage treasury centrally, we run risk management centrally, credit risk management, we run compliance centrally, finance, IT, legal, HR. So all the common functions which are, back office or company running functions are run centrally, which is what Sanjay is running. I'm running along with him for growth initiatives. And then the entrepreneurs who are running the businesses, they focus on the client needs. They focus on sales, order execution. So we consolidate areas that, are not required to be consolidated, but we let our business partners, do the areas where they can get on with the job without having too much bureaucracy or politics or power centers created within large organizations, right? So we created a procurement cell now, which is, every entrepreneur within PDS can leverage for doing synergies and procurement that is reaching big scale, is growing quite fast. You create a central design cell. There's some of the newer companies, they don't have to invest in their own design. They can use that design cell. But when they reach a scale, they can do their own design. So we're trying to consolidate areas that, are having sense to consolidate that can bring cost saving. And the biggest benefit our entrepreneurs see in our model is sharing of knowledge and best practices. So every 2 months, the top 15, 20 businesses come together, sit in a room for 2 or 3 days, share best practices and ideas, share new business models, share the learnings, and they take that back and implement in their businesses. GE used to do that very effectively. They used to bring all their top CEOs around the world, and share ideas at one time. So we are trying to do the same, and that is the biggest value some of these people see from being part of the platform. They don't have to worry about cash flow. They don't have to worry about risk management. They don't have to worry about all the back-end function. They have the leverage of scale of PDS to procurement. Plus, they have the best practice idea sharing between each other.
Sure. Thank you. One last bit. The way Trent in India has succeeded in apparel retailing and fashion retailing, it has kind of shown that brands are a bit overrated. Loyalty of the customers to the brands is somewhat more fickle and less enduring than it used to be in the past.
Yeah.
And the younger people really don't have the same notions of loyalty to a brand as perhaps people at different age brackets, older people may think. And it has shown that how the store itself can become a strong brand by running the business model effectively and ensuring that refreshed portfolio of fast-moving products are provided to the customers, where the store becomes a brand and becomes a source of energy of consumption and growth. In that context, the disintegration of the brands in Europe and America is not very surprising. And given the fact that many of them may just have been idiosyncratic names and somehow acquired brand status at a point of time, but are not able to live up to the underlying quality and other connotations which a brand symbolizes. So what are your thoughts in that, in running your more complex global operation?
See, our customers are the kind of stores you're talking about, right? Zara is not a brand, it's a store which is vertical. H&M is not a brand, it's a store which is vertical, right? So, all our customers, Asda, Tesco, Sainsbury's, Primark, they're all verticals and they have their own sub-brands. So, with that design-led sourcing, they still have a DNA. If you go into a Zudio, they've got 10 brands within their own, which is their own creative brand, men's, women's, ladies, kids. And some of those brands have their own DNA, own handwriting. But the person who will buy, 16 to 20-year-old person will not want to buy the same brand as a 50 to 60-year-old will buy, right? So within a Zara or a H&M, they have sub-brands. So PDS design teams design into those sub-brands. And you're right, today the young customer has no loyalty towards any platform, any retail, any website. They want the best quality design and product. So as long as the product is good, price is right, the trend is right, they will buy the garment, right? So that is how PDS with its 300 designers globally are constantly looking where the new trend is coming and offering that to our customers. And that's how the customers keep coming to us and buying more things. So I think the whole, unless you're a very well-known brand like Tommy or Calvin, people see value. Otherwise, a lot of these small, medium-sized brands don't really have they have a customer, but the loyalty can be questioned for sure.
Thank you very much.
Yeah.
We'll have to take that as the last question. I would now like to hand the conference back to the management team for closing comments.
Thank you so much, everyone, for taking the time out to join our on this call. We shall be in touch with you and look forward to interaction with you at the end of Q4 earnings, and extending our warm wishes to everyone. Please stay safe and take care. Thank you so much, and thank you, EY team, for your assistance in organizing today. Thank you.
Thank you.
Thank you very much. On behalf of PDS Limited, that concludes the conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.